All right, let's jump right into this explainer. We are unpacking the digital payments landscape today to see exactly how an agile, highly profitable challenger is stacking up against a massive global giant. We're looking directly at the buy now, pay later sector, a space that is just completely reshaping retail. And we're zeroing in on two major players with radically different business strategies. So here's the literal $1 million question we're tackling today. By crunching the Q1 2026 numbers, breaking down their business strategies, and doing a direct valuation comparison based on recent market data, we really want to know which approach wins out. Whether you're actively investing in fintech right now or you're just tracking how consumer habits are shifting, this side-by-side comparison is fascinating. To get to the bottom of this, we have a clear roadmap. We'll start with the battle of the BNPLs, dive into Sezzle's Q1 financials, unpack those unit economics, look at how they are expanding their ecosystem, and finish up with a direct valuation comparison. Okay, part one, battle of the BNPLs. This is basically David versus Goliath in digital payments. The contrast in scale and strategy here is just absolutely wild. Klarna is a global juggernaut. They process $136 billion in gross merchandise volume. They boast 119 million active consumers and over 1 million merchants across 26 countries. But despite $3.5 billion in revenue, their net margin sits at negative 8.4%. They are still actively absorbing net losses to chase that massive global scale. Now flip over and look at Sezzle. They are a fraction of the size. We're talking $4.2 billion in volume, 3.1 million consumers, and 40,000 merchants. But look at that final metric, a 29.6% net margin for their fiscal year. Sezzle isn't trying to fight Klarna everywhere at once. Instead, they've built this highly efficient, hyper-profitable model that's focused heavily on the North American market. Moving right along to part two, Sezzle's first quarter financials. We are talking record revenue and profitability here. Let's actually look under the hood and see what is driving that massive profitability. Total revenue jumped to $135.5 million in the first quarter of 2026. That's a really solid 29.2% increase year over year. But the real star of the show here is the net income. It surged by a massive 41.9%, reaching $51.3 million for the quarter alone. When your profit is growing significantly faster than your revenue, that is the ultimate sign of operating leverage in a tech company. They are literally squeezing more juice out of every single dollar that comes in. Well, the secret sauce behind those margins is engagement. A 7.1x average quarterly purchase frequency per consumer, which is up from 6.1x in the exact same quarter last year. Think about that for a second. Loyal subscribers are using the service over 7 times in a single quarter. Sezzle is actively pivoting away from those casual, one-time users and focusing heavily on these highly active subscribers, a group that actually grew by over 48% year over year. When a consumer uses your service that often, the marketing and acquisition costs essentially vanish for those repeat transactions. So that revenue, it just drops straight to the bottom line. Which leads us perfectly into part three. Unpacking the unit economics, or how exactly Sezzle captures these incredible 74% margins. To pull off margins like that, you have to be ruthlessly efficient. Total transaction-related costs fell to a company low 3.2% of their gross merchandise volume. How did they do it? Well, first, the provision for credit losses, which is basically the money they have to set aside for unpaid debts, dropped to just 1.2%. That is thanks to sustained favorable repayment performance and some seriously good AI-driven underwriting. Second, their transaction expenses hover right around 1.7% because they are successfully incentivizing users to pay via low-cost ACH bank transfers rather than those expensive credit cards. Factor in a tiny net interest expense of 0.3%, and Sezzle is retaining a massive 74% margin on their revenue after transaction costs. That's huge. And because of these killer unit economics and record engagement, Sezzle's internal confidence is just soaring right now. They've actually shifted their full-year guidance upward across the board. Revenue growth expectations for 2026 jumped from the mid-20s up to the 30 to 35% range. Adjusted net income guidance got bumped up by $10 million to hit $180 million, and their expected earnings per share jumped from $4.70 to $5.10. When management comes out and raises guidance like this so early in the year, it's a huge signal. It tells us that their subscriber flywheel is spinning way faster than even they originally anticipated. All right, part 4, expanding the ecosystem. This is all about moving well beyond the checkout cart. Sezzle gets that they can't just be a single button on a retailer's website forever. They are actively transforming into an all-in-one financial services platform for the value-focused consumer. For instance, they recently rolled out Pan 5 short-term installments, directly answering what consumers were asking for. They're also launching something called agentic commerce, which includes a closed-end virtual card over in Canada. This allows users to take Sezzle to merchants that aren't even directly integrated with the platform yet. They are even launching Sezzle Mobile, which is an unlimited wireless plan on the AT&T network starting at just $30 for their members. And perhaps most significantly, they're preparing to submit an application for a banking charter by mid-2026. This is a real game changer. It would allow them to offer deposit accounts and transition those variable banking partnership costs into fixed internal costs, giving them massive regulatory defensibility. And here's the crazy part. They are doing all of this without just blindly hiring and bloating their headcounts. As CEO Charlie Yakum pointed out on their Q1 earnings call, they are aggressively leaning into artificial intelligence. They have an AI support chatbot that's already resolving 60 to 70% of support chats without any human escalation. Plus, upwards of 80% of their code is now being written with the assistance of AI. They aren't just using AI to cut costs, right? They are essentially giving their 500 employees superpowers, allowing them to output the work of a massive team of 4,000. This brings us to part 5, the valuation comparison. Let's see how the market actually prices these players. So how do you even compare these two completely different business profiles? The valuation metrics show a really stark contrast. On an earnings basis, Sezzle is priced much more conservatively. They boast a forward price-to-earnings ratio of just 20, compared to Klarna's extremely steep 82.5, against a sector benchmark of 38.2. But flip down and look at the price-to-sales ratio. Klarna presents a much lower PS ratio of 1.7, compared to Sezzle's 7.3. What this perfectly reflects are the vastly different premiums the market places on raw scale versus actual profitability. Because Klarna brings in $3.5 billion in raw revenue, their sales metric looks cheap. But because Sezzle is dropping huge chunks of cash straight to their bottom line, their earnings metric is what looks incredibly cheap. So, I'll leave you with this final thought to ponder. Klarna offers incredible global reach, huge merchant diversity, and an ever-expanding suite of broad banking services, but it comes with the heavy complexities of foreign currencies, intense international regulations, and current unprofitability. Sezzle, on the other hand, gives you a stripped-down, highly focused model. They are utilizing AI to scale efficiently, pivoting hard into a highly lucrative subscription model, and pushing out absolute record profits, but they lack the sheer global dominance of their rivals. In a market that is increasingly demanding profitability but still deeply values global scale, which strategy earns a spot in your portfolio? That's all for this explainer. Keep digging into the numbers, and we'll catch you next time.